Are you new to investing and feeling overwhelmed by all the different strategies out there? Don't worry, you're not alone. In today's video, we'll discuss a popular investment strategy called dollar cost averaging and how it can help you make consistent and steady profits. Watch this video until the end to find out how. Dollar cost averaging is all about consistency. As the quote by American investor Shelby M.C. Davis states, "Invest for the long haul. Don't get too greedy and don't get too scared." This strategy involves investing a fixed amount of money at regular intervals, regardless of the investment's price. By consistently investing over time, you'll be able to average out the cost of your assets rather than trying to time the market and potentially miss out on opportunities. So, why is dollar cost averaging such a popular strategy? One of the main reasons is that it takes the emotion out of investing. It can be tempting to try and time the market and buy low and sell high, but this can often lead to poor decision-making and missed opportunities. Dollar cost averaging allows you to invest consistently without trying to predict market movements. It's a simple, yet effective strategy to help you reach your investment goals. Have you tried dollar cost averaging as part of your investment strategy? Let us know in the comments below. You may have heard the term dollar cost averaging, but may not be quite sure what it means. Don't worry, we're here to break it down for you. Dollar cost averaging is an investment strategy involving investing a fixed amount of money at regular intervals, regardless of the investment's price. This strategy is designed to reduce the risks associated with investing, while also allowing for the diversification of your assets in the long term. One of the biggest advocates of this strategy was an American economist and investor, Benjamin Graham, who described it as a way to invest the same amount of money each month or each quarter. This means that you'll be able to buy more shares when the market's low and fewer shares when the market is high, ultimately leading to a satisfactory overall price for your holdings. To effectively use dollar cost averaging, it's important to have the resources to be consistent in your investing. For example, if you commit to investing $100 each month, it's important to stick to that plan and not let market fluctuations deter you. By consistently investing over time, you'll be able to minimize the effects of volatility and other incidents that could result in losses. How to calculate your dollar cost averaging strategy. As a reminder, dollar cost averaging is an investment strategy that involves consistently investing a fixed amount of money at regular intervals, regardless of the market conditions. This helps to reduce risk and allows for the diversification of your assets in the long term. So, how do you calculate your dollar cost averaging? It's actually quite simple. All you need to do is consistently invest the same amount of money each time. For example, if you commit to investing $100 each month, you should stick to that plan and not let market fluctuations deter you. To calculate the average cost of all the shares you've acquired at any given time for a particular company, you can use this formula. Average share cost equals total capital invested divided by the total number of shares. For example, if you invested $400 and bought 43 shares, your average share cost would be $9.30. From there, you can calculate your total profits using this formula. Total profit equals profit per share times total number of shares. So, in our example, if your profit per share was 70 cents, your total profit would be $30.10. As you can see, the calculations required by the dollar cost averaging strategy are simple and logical, even in the long term. This makes it the perfect tool for any investor looking for consistency in their investments. Now, what are the benefits of dollar cost averaging? As a reminder, dollar cost averaging is an investment strategy that involves consistently investing a fixed amount of money at regular intervals, regardless of the market conditions. This helps to reduce risk and allows for the diversification of your assets in the long term. But what are some other benefits of using dollar cost averaging? One of the biggest benefits is that it helps to form good investment habits and financial discipline. By committing to investing a certain amount of money regularly, you're reinforcing a healthy mindset when it comes to investing. Another benefit is that dollar cost averaging helps to reduce risk. Using this strategy in the long term, you can average out the cost of your investments rather than trying to time the market and potentially miss out on opportunities. One of the biggest advantages of dollar cost averaging is that it removes emotion from investing. By following a consistent plan, you can take the psychological bias out of the equation and make more rational decisions. Finally, many investment platforms now offer the option to automate dollar cost averaging, making it even easier for investors to follow this strategy. This can be especially helpful for those who need more time, but still want to take advantage of the benefits of dollar cost averaging. As you can see, dollar cost averaging is easy to use and comes with many benefits for new and veteran investors. Dollar cost averaging may be the perfect strategy for you if you're looking for a simple and effective way to invest. Now it's your turn. Have you tried using dollar cost averaging as part of your investment strategy? Let us know in the comments below. And don't forget to like, comment, and subscribe to stay up to date with all our latest content. Thanks for watching.